Good morning. My name is Lloyd Brown, and I'm the corporate CRA officer for Citibank NA. I guess we're the fourth largest bank and not one of the banks subject to Neil's prior slide. Today I have the honor of introducing Craig Phillips, Counselor to the Secretary for the U.S. Department of Treasury. Mr. Phillips joined the Treasury Department in January of 2017 and worked with Secretary Mnuchin on a broad array of issues relating to domestic finance, housing finance policy, and financial regulatory reform. Most recently, he was a managing director and member of the Global Operating Committee at BlackRock, Inc., where he was the global head for Financial Markets Advisory Group in BlackRock Solutions. At the Treasury, Mr. Phillips oversaw the preparation of the issuance of the Department of the Treasury's report to President Trump, a financial system that creates economic opportunities, banks and credit unions in response to the executive order on core principles regulating the United States financial system. If you've not had a chance to review the report, it's fairly lengthy, and I commend your reading to it. And there are a number of other reports as well. Mr. Phillips and other Treasury officials have reached out to various stakeholders, financial industry, including trade groups, legislators, mortgage bankers, officials in various national housing associations, think tanks, and consumer and housing advocates to gain insight in our regulatory framework. At the end of the program, or at the end of his remarks, Mr. Phillips would like to hear more from you in a continuing dialogue on the various questions regarding financial reform. We should all look forward to hearing his remarks from the person who led the preparation of the report and how the administration is focused on financial regulatory reform. So it is my pleasure to introduce to some and present to others Mr. Craig Phillips.
Good. Well, thank you. Thank you very much for having us today, and thanks, Lloyd, for the kind introduction. As Lloyd said, I really would like to get feedback, so as much as questions, at the end I'd like to get comments, because what I'm going to try to do for you today is give you a sketch of the work we've been doing to study the Community Reinvestment Act that we announced we would do when we issued our report in June, and give you kind of an update. So I don't have all the solutions or answers, but I guess I'll probably try to sketch out how we see the dilemma, and we see a tremendous opportunity. So on behalf of Secretary Mnuchin and the entire Treasury team, I really appreciate the chance to have this, and it's great to see such an energized crowd today. We really do acknowledge the great work that Buzz and NAAHL does to support the mission to expand economic opportunity through responsible private financing for affordable housing and inclusive neighborhood revitalization. It's really one of the highest priorities of the administration to break the cycle of low economic growth. A lot of our recommendations aren't meant to help financial institutions, but really help the people that the financial system funds, including consumers, small businesses, and lower and moderate income constituents. So really the role housing plays in enabling people of all income levels to build wealth is obviously important, and this is particularly true in communities where the presence of affordable housing provides a multiplier effect for supporting individual and community prosperity. So today I'm going to talk about the work we're doing on the Community Reinvestment Act. We have several of my colleagues here today that have been working on it. They're anxious to hear the other programs. But really, to give you a bit of background, in February, President Trump issued the executive order, which really called for us to study the extent to which regulation, statutes, regulation, guidance, and other factors inhibit the regulation of the financial system in a manner consistent with the core principles. I won't read the principles out, but they're really kind of common sense values of access, fairness, and effective and efficient regulation. So it was really a homework assignment to really effectively study how regulation impacts the regulated, and we truly felt that outreach was the only way to do this, because you really can't evaluate how regulation impacts people unless you talk to people that are regulated. And out of that session, we published the banking report in June, a second report on capital markets in early October, and most recently a report on asset management and insurance that we published just last week. So really this research in banks and credit unions unearthed the fact that after 40 years, I know this is the 40th anniversary of CRA, that it's really time to take a fresh look at the Community Reinvestment Act. Our secretary views himself as a community banker. Now, he maybe was a fancy community banker out in California. He bought a bank that was highly distressed. He turned that bank around and eventually sold the bank. But he had firsthand experience of the potential benefits and pitfalls of the Community Reinvestment Statute. When I say community bank, it was a bit bigger than you'd consider a community bank, but it's unique in that I think he only raised deposits in 4 or 5 counties in California, but yet it lent and serviced loans in 50 states. So he experienced firsthand kind of the disparity of sort of really what's your audience? Is it 5 counties in California or is every 50 states? And this was perplexing to him as a very analytical and thoughtful person as to how he could better help communities, but he found the statute very limiting. The statute was passed in 1977 to address redlining and issues with disinvestment in low and moderate income communities. There was the Fair Housing Act in 1968 and the Equal Credit Opportunity Act in 1974. But on top of that, Congress determined that further legislation was needed to address neighborhood-based discrimination that perhaps was not specific enough in these other statutes. So CRA, in short, and this, what's interesting about what this has turned into is the mission was pretty simple. As I understand it, had 2 principles. One was to assess a financial institution's record of meeting the credit needs of its entire community, including low and moderate income neighborhoods, consistent with safe and sound operations. And secondly, take a bank CRA record into account in its evaluation of an application for a deposit facility, which in principle sounds pretty easy. And I guess the story I'll tell is that it seems that in practice it has gotten overly complicated, and part of our goal is to get back to the core principles. So specifically what we're doing is to articulate that we are supportive of the goals of CRA, but we believe that the regulations and guidance are unnecessarily complicated and burdensome. Secondly, the banking industry has changed a lot since 1977. I know each of you have changed a lot since 1977. I have. You look at technology, the nature of financial service, there's literally no comparison. And finally, modernization of various elements of it are required to take those factors into account. So one thing I say really clearly, because frequently I'll make these remarks and then people will say, well, what do you think they really want to do about CRA? It's exactly this. We support the goal. We think the banking industry has changed a lot, and we want to modernize it so it's more effective. So our mission is not any more complicated than those 3 simple pieces. So really exploring the updated approach to how banks interact and serve their clients is the goal. As I mentioned, the Secretary personally made this a high priority. And as Lloyd mentioned, we've done extensive outreach, including meeting with many of you and your organizations here in the room. So I'd say the general findings that we have is that there's several needs. One is increased transparency in terms of how community reinvestment investments are measured. So the benefits to communities can be more accountable and specific and clear. Secondly, we need harmonization of the CRA regulatory supervisory guidance and how it's delivered in the field. Definitely there's conflicting guidance, and it's complicated by that fact. The assessment area is one of the key issues, and how do you change to adapt to technology, the nature of banking, and even logic as to how there could be more flexibility in the assessment area concept. Improvement in the review and rating process is key. There's issues with timing. There's issues with frequency. There's issues of frustration of institutions having the ability to remediate bad ratings and actually fix that on a timely basis. And lastly, there's issues with transparency on even how the ratings themselves are determined. So that's a lot of stuff, and I'm going to try to tease apart some of those factors today. Someone today asked me about timing. I would say that we're a little past the midway point. We've met with over 60 constituents, which are either bilateral meetings or groups. That's a lot of outreach. The Secretary told us to do extensive outreach, and if there's one thing we're proud of from the work we've done is the amount that we've interacted with all groups of all walks and pretty much had an open door policy to talk to anyone that wants to talk to it. Has been somewhat exhausting, I'd have to say, but also really rewarding, because that's really why we serve, is to really serve people, and if you don't talk to people, it's hard to serve them. So the NAAHL academics, legals, banks themselves, CDFI, civil rights groups of all walks have been into the Treasury building, and it's been a very rewarding experience. So really, as I mentioned, the geographic assessment, clarity, timely delivery, and issues with ratings are some of the key topics, and I'll tackle some of those one by one. So with respect to the assessment area, the key is that a bank has to establish an assessment area, and that's based on a geographic calculation relative to branches, deposit taking, ATMs, and other factors. And this is complicated by the fact, depending on the delivery system of the bank, as to how perplexing that might be. So although these areas have been suitable for a banking environment in 1977, maybe as defined, today the model creates many challenges because of the changes. One is we have branchless banks. So how do you think about a branchless banks? And if anything, that trend obviously might accelerate and sort of be a larger part of what you might call traditional organizations. One, there's alternative delivery channels, which are, even beyond the fact it's branchless, the way they interact with their clients are changing, and we're hopeful will continue to accelerate change. And there's a variety of wholesale and limited purpose banks that don't really fit the traditional model. I was surprised to find that credit unions are exempt from the Community Reinvestment Act, and we're very supportive of credit unions, but that isn't totally logical to us as to why that would be. And obviously you have the emerging topic of fintech firms doing near banking services, of which you might wonder, should they or should they not be included? So all of these things create a lot of challenges, and really the current framework seems to need to be modernized in that respect. So the other is the alignment with the community. And what one would find is that the nature of what's eligible for investment is somewhat unclear, and the framework really can result in sort of a concentration of investment beyond the potential benefit. So there's examples of excessive competition for CRA credits leading to significant price inflation for certain types of assets, such as low-income housing tax credit, and very, very large banks have very concentrated areas of assessments that seem somewhat illogical. So creating this flexibility is of utmost importance. The second thing is, what is an eligible investment? And I've found from working with the team and the feedback we've gotten that there's a tremendous lack of clarity with respect to what type of loans, investments, and services receive credit and exactly how that's calculated. So for example, CRA regulations allow wholesale and limited purpose banks to receive credit for investment outside of their assessment area, provided they've already met the needs of their assessment area. Other banks might not have that flexibility. Bankers and community advocates have told us that more clarity needs to be provided for these factors as to what is adequate. So this is really a key factor if you really talk about the responsibility of banks, which we found very high support for it. How do you have the equal accountability to know how the credit works for this? It really gets most clear when you talk about ratings and the nature of the satisfactory rating versus the outstanding rating and the trend that we've seen in that, and the nature of how banks even set their goals of what rating they're seeking. So I think banks are seeking mediocre ratings in order to avoid failure, rather than establishing stretch goals to achieve outperform ratings and excel in the benefit they provide the community. And we think absolutely that must change. We'd like to see more outstanding ratings, more strive goals and stretch goals, but that's only going to be accomplished if we can address some of these issues with clarity and accountability. That would also lead to another topic of transparency, the nature of these commitments, how you fulfill them, what counts, and how you do that on a more timely basis. We've had discussions about flexibility and types of activities. We recognize there's a tension between needing a type of clarity that we're mentioning and also flexibility, encourage innovation, allow for varying strategies. And it's possible that this just is going to arise from much better communication with regulators. One of the key steps we haven't finished yet is meeting with the regulators. We wanted to really meet with most of the people complying with the statute, community people, et cetera, to really understand the problem and then go to the regulator. So over the next 2 or 3 weeks, we have our regulatory meetings, and I think we're extremely well prepared to have those conversations. We also are going to the head of the agencies to talk about our objectives. So right from the top, there's an appreciation. I know Keith Nurick is speaking here later. I personally met with him with the team the other day. We're meeting with the other regulators to make sure that they know the purpose of our visit, to really try to get some conversation going. Obviously, if you come in critical. And making some of these observations, which if you did just give a summary of the notes, it would not be very complimentary. You don't get support. So really trying to make sure they understand what we're trying to accomplish, so we can have a productive and honest session. I mentioned a bit about the flexibility based on business model. This is one thing I'd like feedback from later. But basically, you have a division for the larger banks that splits between sort of lending and investment and services. And, there could be very clearly benefit to having a flexibility in that. For instance, a service test might be more appropriately for institutions that's focusing on areas of, financial literacy, education, and other services where there's a large proportion of unbanked individuals in the assessment area. In terms of timing, Treasury has discussed this, and this is probably one of the more frustrating things, which is the infrequent and somewhat unpredictable nature of the examination cycle. I think the stated goal is a 2 to 3 year cycle, but we've really been told that in most cases, regulators are not even meeting what you might consider a rather low standard of finishing this every 2 to 3 years. And particularly in cases where there's a less than satisfactory rating, this is of critical need to institutions to have to remediate and fix it. Banks are really impacted by this delay in several ways, but we really have found that there's no evidence that this benefits the community and the other side of this in any way. A community advocate that's relying on an outdated performance evaluation is also dealing with old information. And if a bank actually doesn't have an incentive to quickly fix the problem, that lower rating just lowers the bar for an indefinite period of time. So, so basically the timeliness of the ratings and the accountability to raise the standard so people know how to fix it is really important. In terms of violations and when it goes into the rating, I think this is another factor. Just slightly simplify this is that, originally this was to address redlining and other factors, but since the adoption of this, one huge change is the creation of the CFPB and the implementation of really an elaborate fair lending system. And after the creation of the CFPB, other agencies have raised their game on consumer protection. So it's not like they took it over. I mean, the FDIC, the OCC have been also vigilant, and this is probably all very appropriate since the nature of the financial crisis and the view of banks and some other factors. But really the perplexing thing is sort of how issues with fair lending are measured in the CRA. So if you have a really aggressive and disciplined regulatory system that really measures that, but you then carry it into the CR rating also, you have a double or triple jeopardy situation where you end up in trouble multiple times for the same thing. And if you combine that with the long period, you have a hard time getting out of that and increasing accountability. The CFPB feels they don't even have a direct linkage to CRA, but yet you will commonly hear, well, my rating is being held up because of the CFPB. Well, they actually feel they're not actually holding up the rating. And, they find it themselves sensible, and I've talked to the director, that, every year is a new rating, and if there's an uncompleted study, you could rate the bank, and then the rating may not change when the study's finished. But sort of having a lot of open items with the CFPB and delaying the rating seems to be a connection that needs some improvement, regardless of the quality of the goal. And really what that's doing is holding up M&A activity, expansion plans, lending, opening branches. You would think if someone was in trouble, they should have to open more branches. Well, in fact, they can't have open branches at all. So a lot of these are kind of counterintuitive outcomes. So we're really going to talk a lot with the regulators as to how this came to be, what the fixes are. Do they agree with the problem? I found with a lot of these regulatory observations, you have the fundamental conversation with the regulators to whether they agree that what you're talking about is a problem or not a problem. If they don't think it's a problem, it's a lot harder to have a conversation. Just yesterday, I was in a meeting involving a regulator, a group, and it considered exemptive order requests on a technical thing I won't get into, but there are 5 or 6 dimensions of it, and probably the last 3 or 4, the banking group was describing that it was physically impossible to do what's required. They explained it very clearly, the nature of data, the nature of services, and everything else. And after a long pause, our fellow regulator looked at them and said, "Does this mean you're going to miss your deadline?" And I laughed because they literally had just gotten done describing that actually the activity was actually impossible to do. So I was thinking, yes, the deadline should be never, because they just told you they are never going to be able to finish what you've asked them to do. And in fact, they described it, I thought, obviously truth is somewhere in the middle, but they, actually I thought fairly clearly described a problem that needed a little attention in the statute. Now, in fairness to the regulator, the statute called for certain things, so there was maybe a bit of an ambiguity as to how you would clear it up. But in the case of this, I think what's exciting is it really isn't about this statute as much as the regulation, and that's good because, Congress doesn't probably really want to open up CRA. What was written there is pretty simple, there's a lot of room for improvement. I was trying to think of how I'd characterize this. It's almost like parenting. If you think you have kids and they've done a good job, you might say, gee, you can watch a movie tonight, and quit doing homework. Or you can have, you want a game, you can have, 2 desserts, and if they do something wrong, they have to go to their room. They can't use their cell phone. I remember a period where, I'm not going to say how old I was, but I am older than CRA. And I, at one point, had a paper route. And I had a situation where I used to throw these papers and wanted to land them right on the front porch. And I threw it and it went through the window and broke a window. And my parents said, you need to raise the money to fix that window. So without talking to the person whose window was broken, I had to go do all this stuff to get all this money. And it was a window that had just a pane I broke, but he had to replace the whole thing. So I watched this thing in agony of this window coming out, and they fixed it and all that. And then I eventually had enough money. And I went and knocked on the door and told him I wanted to pay for his window, and he sort of refused to take the money. And I thought, I said, no, you really need to take the money. And I came back a second time and a third time and take the money. So I came back and reported this to my parents. And they said, fine, it's good. But they didn't let me keep the money either, okay? So between parenting and sort of when something does something good and you reward them and someone does something bad and you punish them, and that story, the only thing I can say, it's been a really long time since I've had a paper out, but I just need to get that off my chest because I'm still mad about it. And I think CRA is very much the same way. Banks want to do a great job. They want to invest in the community. These ratings and all the process can be improved. So we're excited to really get this next step out. It'll probably be a first quarter event for us to share our ideas. And we are really looking for a consensus process with the regulators to try to come up with some ways where there's agreement on avenues for improvement as opposed to just dropping a report. So with that, I'd like to pause, and I'd really be interested in any comments, observations, mainly along the lines to, are we missing things, or are there themes that you would put on the table? So are there things you disagree with? I'm really glad to address anything for a few minutes, but I would appreciate any feedback, and really appreciate the time today.
So Craig, Jim Matthews with Capital One. Really appreciate your comments. I think you really understand what the issue is and the fact that banks are really seeking a lot of clarity so that they can do the right things in communities and know that they're going to get consideration for those activities. But I just wanted to point out, I think from our perspective, flexibility and clarity, those two are not mutually exclusive. Just because of the nature of the work and the innovation that continues to occur in the CRA space, flexibility is really important, and I think that there are ways to tie both of those together and to be successful in that space as well.
Thank you.
Hi, I'm Kathy Niederberger with PNC Bank. I have just 2 brief questions. One is, can you clarify the timeline for your report? And you said something about first quarter, you'll share ideas, but then I thought earlier I heard second quarter of next year for a report. And then also, for those of us who aren't deeply entrenched in the regulator world, what is the relationship between you and the regulators for OCC? Like, how will this all flow? So you'll talk to them about the meetings you've had, what you've heard, and then what happens?
Well, maybe we should keep the timing very unclear in the spirit of CRA. No, in all seriousness, we don't have a hard stop. I would be surprised that we don't have something fairly substantive about in the first quarter of next year to really share broadly. What I referred to was a process. Like, these reports we dropped, we kind of drop them. This is one that I think really requires some collaboration. So I guess a goal would be to put out a framework and have that be an organic conversation with regulators, and maybe, again, with industry, a principle-based solution, and maybe some further input as to what's wrong with this solution. So I think it'll be an ongoing process of communication rather than just dropping a report and people agree or don't agree, because that's not going to accomplish much. Now that gets to your second question, is the nature of the relationship with the regulators. What I found from being here most of the year is that while regulators are independent, they really do want to know the view of the administration, and they're very interested in Treasury's view, who's typically viewed as being somewhat impartial and, maybe, less political. I mean, there's more political parts of the government than the Treasury, and we try to look at markets and be stewards of regulation. So I found the independent regulators very open to our ideas, and in general, while there was not consensus on everything we've published so far, there's a lot of action because we've created a framework of thinking about regulation that the regulators generally have found logical and timely, and because of the nature of the crisis and the pendulum swing too far, it's timely to revisit it. So success would be us zoning in from the top of the agency into the mechanisms that do CRA and try to build some consensus both across the agencies on these ideas, but also within the organization. And I think what's tricky about that is some of the feedback is not very positive. People talk about turnover, in the regulatory ranks, the quality of people that get allocated to CRA and how long they want to stay there. Issues with training and other things. So, our style is not to be confrontational as much as trying to get these things on the table, and we'd much rather have a conversation about those things than dropping a report, because criticizing the regulators is not what we're looking to do. We're looking to build a consensus. And I do really believe there's some win-wins here for banks and the community in this, and success would be a negotiated process. But I'd expect, in conclusion, to have something up pretty solid in the first quarter, and then an ongoing process of iterating that into hopefully some either principles that are agreed between the agencies, and hopefully some very concrete action steps that maybe the industry will have a chance to, this is not rulemaking, we have the luxury of having a conversation, maybe the industry will have another chance to comment on the principles so we can refine them.
Good morning. Jerron Levi with the National Community Reinvestment Coalition.
You're right in the front row. I like that.
I could ask multiple questions, but let me you didn't mention the issue around thresholds and the kinds of institutions that, and the types of, you mentioned the services test and it being appropriate maybe in certain circumstances. But I just wanted to get your thinking around two issues, thresholds, and from our point of view, for example, intermediate small banks are subject to a community development test. And it really measures a lot for the work of the people in this room around affordable housing, community development. We have a new report out on that. But we think the work that intermediate small banks, for example, do in terms of community development, lending, and investment as a critical role. And it's important, the CRA obligation in terms of facilitating that. So I'm just curious, your thinking around thresholds, because there's a lot of conversation about it. And also you talked a lot about incentives, banks having some incentives to go above and beyond more than a mediocre rating and all of that. How do you look at incentives? I mean, there's been talk about mergers and acquisition activities, expediting or consideration or so on and so forth. Do you have some thoughts about, based on what you heard, about what kind of incentives or the merger process?
Well, that's a lot, and your organization has given us some great feedback also, as well as on housing, so we really appreciate it. Again, part of this gets into the answers. I'm not really giving all the answers today, but I would say in general with thresholds and other issues that one thing that's interesting about this, if you go from really, really big banks to really, really small banks, and even banks that seem to apparently be focused almost exclusively on low and moderate income neighborhoods, the general dissatisfaction and issues with CRA is actually unusually consistent. and sort of relationship with regulator, timeliness, clarity, et cetera. So that was one thing that was surprising to me. I thought there would have been some inconsistencies, but generally, a lot of the themes are very similar. In terms of thresholds, again, I don't want to go too far down the road, but I think in general, we did hear a lot about limits when things kick in, how they kick in, and definitely thresholds in general for things like stress testing and other liquidity standards can become these kind of hard lines that then are hard to smoothly move into. And so we'd like to harmonize activities in general, without thresholds that create unnatural burdens when you hit whatever threshold that is, because it's just hard to adapt and can create somewhat of a market distortion. We think things like M&A, capital raising, branches, these are good activities for banks, but they're also good for community. So a lot of this is how do you, if you talk about the bank having responsibility to community and they have to do a certain amount of good, how do you measure that good and sort of make that on a timely basis? And then how, if they've done something wrong, how do you give them the path to correct it? So I guess I don't have anything more specific on the answer because we really haven't developed a recommendation, but I'd say those are some of the themes. Allowing a bank to get out of trouble quicker by being more accountable for measuring it, we're fine with. So we're really not trying to make this easier on banks. We're just trying to say, well, if you've had an issue with compliance, here's the consequence of it, and here's the path for you to improve the rating, which gets into the outperformance and the other higher ratings. People aren't even shooting higher anymore because the risk of then failing can bring them back 2 notches and other things. So, one of these things, if you get everyone on an uplifted mode of actually being more certain about the outcome in the process, we think will raise actually the rating. And what I found in general with these regulations is even if there's a regulation that people really don't like and they think it makes no sense, they generally are okay with it if it's clear. The things that bother people the most are things that are really unclear and vague, and they may not like it either, but the bigger problem is that it's unclear and it creates kind of an uncertain regulatory environment. So really the CFPB and some of the consumer protection rules we've commented on, if we could get them clear, it'll create a more certain environment. And we think that kind of ties into CRA in the sense that if you are being judged for your consumer compliance and you have fines, fees, and settlements for that it creates a band of accountability. But if you overly intermingle that with the CRA rating, it's kind of a double jeopardy and creates a disincentive. Well, I have this problem now. I'm going to have a problem for a while, so why should I improve my performance until some much later date? So this whole timely thing, it's like parenting before. You don't wait 3 months to tell your kid that they can't have their phone. You tell them right away when they're in trouble. So we're for accountable bill both ways: positive, better ratings, knowing what it takes, and consequences when they actually haven't delivered. I don't know if that's kind of a philosophy, if you will, but I think in the next stage we'll get more specific, probably on thresholds.
Good morning. Bank deposits drive CRA responsibility. Have you given thought to how we might pull deposits out that have nothing to do with the assessment area of that bank?
Well, this is an interesting topic because our final report under the executive order is going to be in the area of non-bank financials, financial technology, and innovation. And I think what we'll probably find in that report is that the whole future of financial services and the extent to which they're going to be delivered through branches are going to be really different. So I don't have an answer to your question other than think that we really have to rethink the whole thing. And if we're really talking modernization, we should think about the future, not just the present, because we're now, I think the thrust of your question is we're really behind effectively in what's happened, and modernization is going to be a state of change that's going to be very rapid. And if everyone's banking, if you've opened a branch, an account at a branch, and you maybe didn't go to the branch when you opened it, but you thereafter never set foot in that branch because you're doing all your banking on the phone, and you in fact move to another city or state, and you still are registered as having that branch relationship. I think we can all picture that's no longer accurate, but it's very much the trend that's happening in technology. So I think when we talk about modernization, we're really going to try to sort of create a framework of not to be too ambitious, but really deal with the fact that the physical branch concept for a deposit is no longer, I don't know if you'd agree with this, seems to be no longer descriptive of the nature of the banking relationship. And if that's where we're starting, that's a fundamental problem. Is that your point, would you say? Okay.
So I'm going to take a prerogative and make a concluding comment before thanking Craig. And under the rubric of penance and your newspaper delivery, you already know that Kip and his team are doing a great job, and anyone who has to meet with 60 people on the same topic also deserves a round of applause. But thank you very much for your
Good.
comments.
Well, thank you very
I look
much, and
forward-
thank you very much.